wealth in times of uncertainty. Since Bank of Singapore brought you all three panelists initially, even though obviously James and Gareth are going to make very clear they're not, they're from HSBC and Nomura. I'll give Jeannie the chance to answer the first question, which is, from an Asia wealth management perspective, what is the greatest risk or uncertainty out on your mind right now? Is it a macro concern, a regulatory one, a security one, a geopolitical one? What is it?
Thanks very much, Mark. And it's great to be among friends on a chat on stage, but I think we have very much in common, but at the same time, I think we will contribute to this discussion with also very different perspectives based on our pre-call. So in terms of risks, I think what we can't get away right now is really geopolitical, right here, right now, which is, in our mind, I think China is at a turning point, and a very important one, both from a geopolitical perspective, but also for us, which is our focus as investors in terms of where we might position China within our portfolios. I think, needless to say, this is an important part of everyone's portfolio, but the risk premium and also how we invest in China has clearly changed over the last 2-3 years, and I think we're at a turning point there. So China, for me, is both a risk, and later on we will have more discussions on whether it's an opportunity or not.
So China, the risk and opportunity, how you invest in it isn't changing. James, from your point of view, what is the biggest risk out there for Asia wealth management?
Yeah, maybe Mark, just to take a step back. Although we are all friends, this forum is actually sponsored by HSBC.
It is absolutely fair. Good point.
Just jokes aside. Well, I think the macro environment, clearly it's going to be something that everyone is watching out for. And I think we are braving a brave new world of much more macro uncertainty. Well, disruptions from the pandemic, the war, as well as climate change has forced shortages, energy shortages, labor shortages, and of course that's causing inflation to increase. Clearly the driver this year is central bank action, and central banks have to increase rates, tighten monetary policy so as to slow growth down and hopefully bring down inflation. Well, I think the most important thing, of course, for investors right now is to watch what the inflation outlook will be. And if you can get that right, probably you can make better sense of the market. Well, for inflation outlook, in my view, I have good news and bad news. Probably I'll start with the bad news first, so probably you can have a lunch, more peaceful lunch. Well, the bad news is I think that inflation outlook in the next few months probably will worsen. That's the bad news, so we get that out. The good news is I think inflation should actually stabilize going into year end. Really because we are seeing the stalling of commodity prices, wage increase is starting to level off with labor supply coming on very strongly. And of course, ultimately, the effects of tightening policy would slow growth down, and I think that would ultimately bring inflation down. So if that's the trajectory, then of course, it also means that central banks, particularly the Federal Reserve, will still have to increase interest rates. Perhaps not as much as the previous July meeting, but the magnitude probably will be a little bit more calibrated. So I think that's going to be roughly the trajectory of inflation. And of course, once you get a plateauing of inflation, the trajectory of Fed rate increase will be much clearer. But meanwhile, I think there's still quite a lot of uncertainty. Growth is going to slow down. And I think the next marker to watch out for, of course, is the earnings season, which will have more downgrades, more guidance looking forward and lower. So I think from that perspective, it's still going to be a very tricky environment, and macro risk will kind of dominate headlines.
James, I've never heard someone present such a gloomy outlook in such an enthusiastic and positive way. Inflation is coming, tightened financial conditions, downgrades. It's going to get really bad, but it's going to be great, and enjoy your lunch. And on that note, Gareth, what do you see as the risks?
Well, I think the risk, which, like you said, have been highlighted pretty positively, but there are big risks, is China, is the macro picture. If I had to try and think of a third one, it would probably be security, and particularly, I think, if you look back at the Russia-Ukraine conflict, I think this is going to be a watershed moment when we look back and say, wow, domestically people are really focusing on security. And I'm not just talking about the conflict, but energy security, food security, cyber security. These things have become everly more important. I think particularly for energy, this is the one that I think is going to be a front and center and a big opportunity. I mean, Europe already, if we put some numbers behind it, Europe Green Plan is already 1 trillion euros over the next 8 years to try get it towards a more neutral level. And I think that's important because what is interesting with energy security is also aligns very nicely with energy sustainability with the transition of energy from certain countries which have dominant dirtier energy to renewable energy, which can be done almost anywhere. And I think this transition has become particularly more interesting for our part of the world where infrastructure is so underfunded. I mean, the numbers we look at, we see $100 trillion of funding needed over the next 2 decades just to keep the lights on in developing economies. I mean, that's a huge number. How are we going to fund that? How are we going to, keep the lights on? And we know that power is highly correlated to GDP, it's highly correlated to sustainability, jobs, supporting SMEs. So we think this is vitally important. And Nomura, one of our key focuses is financing this side, particularly through our partnership with the Nomura Green Tech. And I think this is where the value is finding opportunities to be able to fund this. And I think besides the public markets, I think private equity, private credit is going to become even more important in this space. As our previous speakers talked about alternatives, you have a real ability to dive in, understand the risks, be able to manage it. Yes, you're giving away some liquidity, but through transparency, this becomes really interesting. So I think that risk is also going to become one of the biggest opportunities.
You can see why I love this panel, right? So James sprinkles his doom-mongering on the macroeconomy with lunch mentions. And somehow Gareth managed to talk about security risk and energy crises and say it's a great opportunity. So on that note of opportunities, James, where do you see the big opportunities out there, apart from lunch?
Well, I think structurally, I think Southeast Asia is something everyone should watch out for. Clearly, the economic gravity is shifting to Southeast Asia, but if you look at general investors, global investors are still very much underinvested in Southeast Asia. And for people who look at Southeast Asia over a long time, it's almost like watching a movie, but slow motion. It's always moving in the right direction. But of course, the prospect is bright if you look at historical data. So I'll give you some statistics. Back in 2000, Southeast Asia trade with mainland China is only about 40 billion. Today, it's 850 billion. So it's increased 20 times. And the size of Southeast Asia's economy compared to back in 2000, compared to Japan, for example, Japan was 8 to 9 times larger than Southeast Asia. Right now, Japan is only 1.5 times larger. And clearly, in the years ahead, Southeast Asia is going to catch up. So what's also very important is that Southeast Asia has very different complementary strengths. Of course, Singapore, financial center, strong manufacturing base, industrial powerhouse. And you have, of course, in Thailand, for example, it has a very strong automotive industry, Malaysia, electronics production, and Indonesia for its natural resource. And this year, with the implementation of the Regional Comprehensive Economic Partnership, the world's largest free trade agreement, it's going to tie the region together and would spur investment and trade in the years ahead. So I think that's going to be a very interesting proposition that investors have to consider Southeast Asia. It's a 3 trillion economy, sits at a crossroad of 3.4 trillion of global trade every single year. So that's something that I think investors have to think seriously about in the years ahead.
Okay, and Jean, you already kind of hinted that China, the big risk, but also the opportunity. Where do you see the big opportunities in the region?
Right, so maybe let's step back a little bit and look at this year. So first half of this year, what we've experienced is really correlation, and in a bad way, right? And correlation was very high, and most investors really found it very difficult to buffer that volatility in any asset class, whether it was treasuries, and also fixed income in particular, because of the dramatic moves we saw in terms of the interest rate environment. So I think there is definitely a quest for a alternative source of return, and your previous panels did speak at length about that, which would be alternatives. But I'll also throw in there style investing. So risk premium, for instance, is one of the areas we are looking at as a potential area that can provide us with an uncorrelated source of return. But funky things aside, let's go back to first principles as well, right? Let's look at, good old-fashioned equities and bonds. Where are we in this stage? So as a house, we were underweight fixed income for most part of this year, but we actually upgraded investment-grade developed markets in the last couple of months. The reason is we feel that recession risks have picked up, and with that in mind, notwithstanding the very hawkish stance that the Fed tries to portray, as you've seen also in the most recent conversations, the long end is beginning to be anchored, and that actually bodes well for fixed income and in particular investment grade. So we're starting to also warm up to some of these opportunities. Not in a, it's not a binary decision at this point. It's very much still a credit selection story as well. But at the same time, we look at equities, right? What we think about China is that one does not have to make a binary decision. One does not have to say, I'm in or out of China. China is just changing as a market in terms of the evolution and sophistication of investors, and the fact that we may have to think about China in a different way. Gone are the days that we can buy an index on ETF and sleep tight. We really have to focus instead on, what are the onshore and offshore opportunities, what are the opportunities in private markets as well within China, which is why we are also doing a lot of work behind the scenes to work with onshore partners, whether it's securities firms or fund managers who really understand the risk there. Increasingly, we're also hearing that investors are looking at China not as part of EM, but EM ex China and China. So in a way, it's almost evolved to become its own sub-asset class. And so we need to measure and calibrate Chinese risk very differently. But at the same time, we mustn't miss the forest for the trees, because China is just in a different part of the macro cycle, given that inflation risk is not as high, and there is room for accommodative monetary policy. On the other hand, in terms of the innovation cycle, particularly in green tech, right? I mean, the pace at which EVs are being developed, and the EV infrastructure most recently as well, that was announced by the Ministry of Transport, we see this as actually a strategic and structural opportunity. So one just needs to be a lot more involved and engaged in terms of Chinese investment.
Okay, Jean, there's an audience question, which I'm going to come back to maybe in a second, about interest rates, given that you're talking about adding duration selectively in fixed income. But I want to go to Gareth first. You talked already about the energy transition providing an opportunity. Where else do you see opportunities in this world at the moment?
Well, I think the two topics, regionally, I think the region here is fantastic, and I think we're in a different part of the cycle, and fixed income is becoming far more interesting. I think it's also about how you invest. I think that's an interesting part that we shouldn't forget. We're in an extremely complex environment, and even though we're trying our hardest to be upbeat about the risks, there is a lot of risks out there, a lot of difficulties, and how do you get around it? One of the free lunches, like the lunch today, is diversification, but you need to play that. And I think as portfolio managers, as traders, one of the things which we all know is idea is only as good as its execution. How do we execute some of these ideas? And this is where I think it's interesting to look at the number of new tools that are out there. If we go simple to ETFs, ETFs were traditionally a nice way of buying the overall broad index. Now ETFs have expanded so much that you can get really specific about different parts of the sectors, different parts of the curve, different thematics. And I think this really helps active portfolio managers, active investors take advantage of single line securities, plus maybe beats it from ETFs, or be able to position portfolios in a much more effective way. It's not about making portfolios complex, it's actually, I think, about simplifying them. These instruments have made it simpler for us to get exposure to something that we have a high conviction in. And there's a number of asset classes which we think are interesting, across the EV, the green energy space, for instance, but it's not about the specific asset class, it's about getting there in an effective way. And I think ETFs is a really interesting way to complement portfolios, particularly in private wealth, where there's ultra high net worth, and then there is a different scale. And I think that's exciting, is the amount of tools that are now available to be able to get these different views in this complex world.
Okay, cool. So we've had an audience question about how high do you think central bank rates can go? And that's a very general question. So before you answer, I'm going to narrow it down. And I'm going to love this, because it sounds like James and Jean are on opposite sides here. And there's nothing I like better as a panel moderator than a bit of an argument and a fight. So I'm hoping to stir that up. I'm going to specify, since central bank rates is very general, I'm going to say, how high do you think the Fed will go? And we should say that what's priced is about 3.5% by the end of the year, and then there's a pivot that is expected to be some cuts next year. So do you think that we're going to go much higher than 3.5%, or do you think that's roughly right? I guess I'll go to James first.
Well, I think that's roughly right. We think it's a little bit more, probably 25 basis points more. And I think that's roughly where we think the rates will pause for a while.
Okay. Jean?
Unfortunately, we are about the same as well over there, so there isn't a fight that you had anticipated. I think right now, our projection is really that the Fed actually front-end loads the rate hikes, and the corollary we see is actually 1994. I know some of you in the room maybe do remember that. Others, probably that's not in your radar, because you're way in a different age bracket than the rest of us. But I think where we see the Fed acting is very similar to those conditions, where front-end loaded rate hikes will come on board, and then we'll taper. And then that actually was, in 1994, the trigger for a very strong rally from 1995 all the way to famous last words, 2000. So we do think that the stage is set in terms of potentially addressing the inflation question very early on, and then taking care also of, in terms of jobs in the US and recessionary risk. So we don't rule out a recessionary environment. However, we think it's more of a bend and not break type of recession, because I think the central banks do have that very much front and center in terms of their priorities as well at this point.
Okay, Gareth, don't tell me you agree.
Well, yeah, afraid I do. But to a slight different, we do think that recession is actually going to be this year, Q4. So we actually believe our house call is for recession to be earlier, and we think the Fed are going to aggressively move towards that to bring it forward, as such get on top of inflation. That is the plan. This last meeting was a bit of a surprise, I think, for many, and I think to understand where the Fed is going, because to be honest, we don't think the Fed is in a fantastic position to fight inflation at the moment. I think they've got a lot of work to do, and they need to spend these next 2 months really talking the market up and see what happens in September. So I think September is going to be really, really interesting, but we have our terminal rate at 375, 350 to 375.
I'm going to have to fight you all afterwards because I think rates are going much higher than priced. I think the inflation environment is very different from 994, but no one's here to listen to what I have to say. So I'm going to go instead to the next question before I get on a bit of a tangent about rates. I'm curious about any other underappreciated kind of nascent trends in the industry that you think people may be unaware of. Obviously, we had great panels today, talked about a lot of this. I'm just wondering if there's anything else that you heard or missed, or maybe you want to re-emphasize is kind of really, really relevant in today's world. Jean, I'll go to you first.
I think for me, it's ESG investing. So for the first, half of the year, perhaps, many people start to sort of question, right? So they have existential questions about, is ESG investing actually the right way? And, does that mean it's less important because of the underperformance? Energy has massively outperformed. So if you own an energy fund versus a sustainable fund, you see the opposite outcomes. So does that mean that, it's a compromise? A little bit to what Gareth said as well, which is that actually it's the reverse. I think it's actually put the spotlight on the fact that Europe is at its knees in terms of energy security, and therefore there's really renewed focus on the urgency of decarbonization of renewable energy sources. So I do see that as an opportunity. Not all of it's in the listed space, granted. In fact, some of it is so early stage that it's almost like, a pie in the sky dream state where, can we decarbonize to the extent that air is turned to rock, for instance. So I think some of these opportunities may be hard to access, but the issue here at hand is the urgency has become greater, and so investors should actually take sustainable investing much, much more seriously, I feel, for the long run investor. So for whatever it's worth, it's actually an opportunity when people deprioritize ESG. Perhaps we had been a little bit more superficial in terms of how we looked at ESG in the past, whether it was just ratings, labeling. I think those days are gone. We have to be a lot more, as in the evolution of sustainable investing, look at the devil in the detail, which is really, what is this company really doing? Do I believe them? How am I stress testing it? How about this fund manager, etc. So I think the sophistication increases, and hopefully the long-term performance outcomes are also follow.
So greater sophistication in ESG and the differentiation there. James, I want to come to you next, but brilliantly, you couldn't make this up. I want to ask you the same question about nascent trends, but I've also had a question from the audience, which I think ties in exactly with what you want to highlight. And the question is, will the 60-40 portfolio no longer work? So tell us your thoughts.
Yeah, well, I think we must sort of have a paradigm shift when it comes to a 60-40 equity bond portfolio or a 50-50 equity bond portfolio. Why is that so? Because since the financial crisis, the playbook was simple. Whenever there's any growth scare, central bank to the rescue, cut interest rates, do QE, and then markets bounce up. Both bonds and equities did very well in that playbook. But I think that the macroeconomic conditions have changed. What we have now is that we now have inflation. In the past, there was no inflation. And of course, with inflation, and now there is a price to money, the interest rates is back on. The playbook has to change. Clearly, at a time, a rising tide lifts up all boats. But I suspect now, because of a much more difficult environment, it's no longer a rising tide that lifts all boats. You probably have smaller waves, you probably have shorter economic cycles. And I think in that environment, what worked well in the past, that 60-40 portfolio, might not work as well in the future. And I think there is a need to rethink about that formula. And to me, I think in a more complex environment, you clearly have to add alternative assets, a big slice of it, into that whole mix. Alternative, of course, includes private markets, includes hedge funds, include real assets like commodities, real estate, etc. And I think that sort of portfolio would be much more resilient and much more future-proof in the years ahead.
Like, that sounds intuitive, but I do feel the call for the end of 60-40 portfolio is like calling for the end of the JGB bull market, or calling for the return of value stocks to outperform growth. But I hope you're right this time, because it makes make more sense for active investors and people who kind of study this stuff. Gareth, what do you see as the nascent trends in the industry?
Well, I think to James' point, this idea that you've had central bank basically lifting up all markets, squashing volatility, has meant that a lot of investors has had a bias towards looking at a stock like US equities and basically looking at everything else as the beta of US equities. And what I mean by that is people have had exposure to the US, to very developed markets, and maybe a regional bias. If you're from Thailand, maybe you like Thai equities or stocks. If you're from China, maybe some certainty there. But the portfolios haven't really been that diverse, not to the point like James was talking about having large exposures to alternatives, etc. But I think in this environment where we are getting a push towards deglobalization, where we are getting different regions focusing on more growth within the region, we are getting different parts of the world growing at different speeds, and you're not getting that one unifier central bank coming up and kind of lifting it all. This means that portfolios do need to become a bit more broad. We shouldn't be focusing just on what everyone looks at, the US equities and maybe your niche. You do need to expand out. And to do that, we really recommend partnering. It's about creating those diversified portfolios with partners, focusing on what you're good at, but not forgetting that there's other parts that are going to help improve this income. And I kind of think of it like, if you don't mind me using a baseball analogy, for the last few years, it's been around finding that home run, hitting that home run. The previous speakers were talking about a sector that was incredible over the last few years. I don't think we're going to have that many home runs over the next few. I think it's more about filling the bases up with solid income-producing investments. And then we just fill them up and just see that moving over. You're going to have to look for multiple strategies which are going to offer you value and be able to move it around. And often you're not going to be an expert at everything. And this is why it's interesting to talk to banks that focus on different things, at different specialities, and find solutions to create the goal of a diversified portfolio, creating that stable income. I think that's basics, but we've got to go back to that.
It's a very common theme you're all saying there: greater sophistication, greater diversification, being a little bit more specialized in kind of where you kind of focus. We've got several audience questions. We're going to make it quick fire. You can all see we've got just over a minute left, so I'm going to ask one for each of you. Gareth, you first. These are all from the audience. Given the expected fast pace of US rate hikes, is there a risk the outflows could be bigger than some emerging Asian economies can swallow?
Sorry, I missed the last bit.
Is there a risk the outflows could be bigger than some emerging Asian economies can swallow because of the rate hikes in the US?
We think that the risk in emerging in EM is high. There's going to be very diversified. You've got to look at the different growth engines, but yes, we think that there is material risks in EM. We have a table ranking them, and we keep a very close eye on it, and we do think that there is going to be some serious pain still in emerging markets, given the strong dollar, given the fundamentals, given the last few years. I'm from South Africa, a lot of African countries have really binged, like other places, on credit, on debt, and that's going to put a lot of pressure on these economies, particularly if they're not growing at the same speeds they have been for a number of years.
Good quick fire answer. Right, James, you next. As much as the Fed can fight inflation with interest rate hikes, there will still be a risk of stagflation. How do you plan on preparing your portfolio for that?
Oh, well, it's true. The interest rate is actually a very blunt tool. It can't solve all the problems of this world, and a lot of the inflation is due to supply-side issues. And so I think clearly how do you prepare for that, of course, is that you want to, first, of course, we have mentioned a diversified portfolio, look at alternatives, but also look at asset classes that does well in a higher inflationary or higher rate environment. Commodities is one example, real estate or even infrastructure assets that allow the interest or the rental or coupons to actually reset higher. Those are key, some tools to help you tide through higher inflationary environment, and I think that these are the ways that one could actually help you kind of increase income and resilience into your portfolios.
Gene, don't worry, we're out of time. We're not on live TV. We can blow the hard break. There's no advertisers to complain. One final quick-fire question. Sure. Do you think we've been focusing too much on the E, environmental, compared to the S, social?
Yeah, I think in terms of the environmental aspects, I think that's the measurability is what we've been focused on in terms of the urgency as well. I think social is certainly very important, but in terms of being able to measure that, that's even a greater challenge. And with that comes all the value judgments as well as to your social, what social really means in different markets and to different investors as well. I think what's important today for wealth anyway is to really understand our clients as well as individual investors of what is the objective and also what speaks to them. So in Europe, for instance, starting actually last week, wealth clients have been asked to profile themselves in terms of the areas of ESG factors that actually are important to them that they will prioritize in their investment journey as well. I think Asia will get there as well because I think we all have different convictions and different objectives in terms of investing as far as ESG is concerned. I think the other aspect is also of governance. I think governance takes care of us from a risk perspective, and we as Asian investors need to really pay attention to this risk because we've seen, for example, how this can really impact our return when we're in companies that we perhaps had underestimated in terms of the importance of how governance might actually just take the rug below them, and we can see some companies actually fail because of governance issues.
Brilliant. Jean, James, Gareth, that was absolutely fantastic. Thank you very much. Can everyone please give them a round of applause? Thank you.
Thank you.